Hi, this is Jessica Dunn, and today we're going to discuss stock valuation. In particular, we're going to be looking at multiples. So you can use stock price multiples to estimate your company's stock price. Analysts often use the price earnings multiple, which is price per share divided by earnings per share, as the multiple that they multiply earnings per share against to calculate the value of a stock. So to do this, you would first estimate the average price earnings ratio for your comparable firms. That would be your price earnings multiple. So the average price earnings ratio for similar firms is your price earnings multiple. You then multiply this price earnings multiple by the expected earnings per share for the company that you're interested in valuing, and that gives you your price earnings multiple share price. So it's a real quick, easy way to determine the value of stock. And here's an example. Company X has earnings per share, expected earnings per share of $7.70. The average price earnings ratio for a set of similarly publicly traded companies is 12. That means that investors are willing to pay $12 for every current dollar in earnings. So the intrinsic value then would be the expected earnings per share of 770 multiplied by your price earnings multiple of 12, so $92.40. So it's a real nice, easy way to quickly evaluate the price of a company. You can do it with other multiples. It doesn't have to be the price earnings multiple. That's just the simplest approach. Another approach would be the entity value. So you could look at the market value of equity plus the value of debt. And so then you would pick a measure like sales or the number of customers or the number of locations and calculate that average entity ratio for a sample of comparable firms. So example would be you would take that entity value that you calculated, the market value of equity plus the value of debt, and divide it by whatever measure you have chosen. You would then find the entity value for the firm that you're looking at. So you would multiply your company's, whatever it is, the market value of equity plus the value of debt, and divide it by whatever measure you chose. So if you had chosen sales, it would be the entity value divided by sales times your company's sales. So if you did it by customers, you would multiply the company that you're looking at's number of customers, and you would multiply that by the entity value divided by the customers ratio. The result gives you the firm's total value. So you do have to factor in how your capital structure looks. So you would have to deduct off the debt and anything that is owned by preferred shareholders, then divide by shares of common stock outstanding to get your share price. So it's a bit more complicated. The problems with market multiple methods is that it's sometimes difficult to find comparable firms. There are lots of companies who operate in many different divisions in lots of different locations, and it's difficult to find firms that are similar. Another problem is that the average ratio for the sample of comparable firms often has a wide range. So you may find that the price earnings ratio for a group of similar companies is all the way from 10 to 50. So you need to decide, should I look at the low end or the high end or the average? So there are some decisions that you have to make with this, but it is so simple and quick that it's a very, very popular methodology.